Good evening, everyone. I'm Clay,
Yeah.
joined by E-Train, lovely and gracious as ever, even washed her hair. So we're all doing good. I washed mine.
You
Hope
mean
it
I
has a
dried my
nice,
hair?
nice shine.
I
Yes,
dried my
she
hair. That
actually
is the
dried her hair. We're not used
yeah,
to
I know,
seeing the
right?
dry hair.
Mm-mm.
So it's good to see y'all. Jane, it's Sky. How are y'all doing? Appreciate y'all joining us tonight. Um,
Absolutely.
it has been a nice dry weekend. I'm not sure actually what's on the horizon, but we shall see. We got that storm blowing up through the Gulf. A lot of them will come on up through here. So we may be in for a bit more rain, but I haven't checked the latest weather, but hoping y'all are doing well.
Thanks, Guy.
Checks in the mail, Sky. Thank you. And I freely admit Ellen has prettier hair than I do. In
Well, yeah, duh.
fact,
I thought that
she
was
was all she was
obvious.
all excited. She just had it cut and highlights,
I
tinted,
like the first time in 2 years, tinted. Stop it. You're gonna say
whatever.
frosting next, and I'm gonna fall out on the floor.
Had the tips done.
Oh God, no, no, absolutely not.
Hope y'all have had a good start to the weekend. All my favorite teams lost, so
Yay!
I'm about to give up on football this year.
And once again, for those of you who do not know, I am looking at 4 different screens. So if my eyes are doing this, it's normal.
Yes, we're on a couple different live streams, Twitter and Rumble. So if y'all are watching on one of those platforms, you have any questions, Ellen will relay it.
Mhm.
Basically, the system we have feeds off of YouTube and it doesn't directly post those comments. So that's one reason why Ellen keeps an eye on the other channels. So if you've got some questions, feel free to ask or comments, feel free to throw them up. We will get to them. And obviously, if you're on YouTube, those will feed in directly to our channel.
Yep.
Like to welcome everybody to Saturday Night Live and Rambling, Moffat on Money's version of Saturday Night Livecast, where we untangle complex, weird, unusual economic trends, try to offer some clear professional guidance to help you navigate today's, markets. I got to say hello to Melissa. How you doing, Melissa? Good to
Hey,
see you.
Melissa.
Appreciate you saying hey. Today,
We probably aren't
the
as entertaining as Saturday Night Live, but we'll try.
what'd you say? I'm sorry, cut
I
off
said
on me.
we're probably not as entertaining as Saturday Night Live, but we'll try.
But the information you get is much more valuable.
Oh, mm-hmm.
So it's quality over. Of course, the way Saturday Night Live got to be the last few years,
Mm-hmm.
we might be better entertainment. We
I don't
might have
know.
actually more humor.
Well, as you see, my description here is creator of shenanigans. That is my job to derail Clay anytime I can and try to get him to explain things that no one else understands except for him.
Ellen has her gifts, and that is obviously one of the more prominent, and she uses it to full extent.
I do. I do.
And but we really encourage an open forum. Any comments, questions, or whatever you have at any time, we will try to get to, because we want your
We'll
involvement.
definitely get to him. Don't worry.
Yeah. Tonight, via popular demand, actually had a request from one of the family members to explore the multifaceted world of real estate. Real estate, whether it's home or commercial, is one of the hottest topics on everyone's radar right now.
Mm-hmm.
Whether you're a homeowner, a potential homeowner, wannabe homeowner, an armchair economist, a real estate investor, a commercial investor, we hope to help you understand where the market is headed. Tonight, we're going to focus mostly on the housing market. We have talked about commercial several times. And so we're going to take a look at the other side, the housing market, and hopefully give you some better information of how you can stay ahead of the curve. Now, we were asked the question and sent or forwarded a couple of articles. These are the articles. Fed's rate cuts could have unintended consequences for the housing market on CNN, and housing markets in California, New Jersey, Illinois still have elevated risk of downturns. So those are the two articles that have kind of framed this discussion, and we'll proceed on that basis. We're going to start off talking about something called the locked-in effect, which we have alluded.
Before we go there, I have not seen the show's notes, by the way. Clay has not shared those with me, so I might be getting a little bit off track. However, the mean house sales in the United States for a realtor last year was 2.
And they may be lucky to get that many this year.
50% did none. 0. Zip. Zilch. Nada.
Yeah, there's a reason why a lot of people have gotten out of real estate sales. The market has just tanked.
Now, you do have those realtors that are pretending to be realtors. Fair. There's a lot of housewives around here who go to real estate school, which just said they can tell their husbands they got a job. You know, I'm telling the truth, Clay. So anyway, that there is that tiny percent of realtors, but I mean, most of them get out there and try to do their thing. But yeah, that's just a little. Sorry. Go ahead.
No, that was just simple truth, simple fact of the present reality we're in, and we're going to talk about one of the reasons for that. It's called the locked-in effect. And I've alluded to this on a couple of previous shows here and there, but it is a situation brought about over the past few years of Fed policy decisions and, I'll just leave it at Fed policy decisions that keep homeowners from selling. It's the realization of the Fed's interest rate cuts on housing prices as well, on mortgage demand, and on even the broader job market. So we'll explore each one of those issues as we go through the night. We'll explore which markets are set to skyrocket, which ones might be in for a bit of a nosedive. So buckle up and enjoy the ride.
But you would think, Clay, with the lower, the Fed cutting the rates by, what was it, 0.5?
0.5%, half a percent.
That would help the real estate market.
A lot of people do think that. I don't necessarily.
I agree.
And we'll cover that. Let's start explaining what the locked-in effect is. It's a phenomenon we've really never seen before in real estate history, and it has emerged to be the main the force de majeure over the past year. Think back to 2021, 22, when interest rates were historically low. Homeowners were snagging 30-year mortgages in the 2.5% to 3.5% range. I mean, honestly, looking at it from a historical perspective, that's free money. Basically free money, because a homeowner gets to deduct interest on their mortgage. So if you're in the 40% tax bracket and you've got a 3% mortgage, that leaves your interest rate that you're net paying at about 1.8%. That's as close to somebody giving you money as you will ever see in your life. So if you were lucky enough to buy a home or refinance your mortgage during this period, congratulations, you won the mortgage lottery. Now, if we fast forward to today, what do we see? Mortgage, easy for me to say, mortgage rates have been up to 7.8%. Right now, they're hovering around 6.75, even higher in some markets, but that's the national average. So if you're sitting pretty with a 2.5 or 3% mortgage, the last thing you want to do is sell your home, pay off that cheap mortgage, and sign up for a new loan at twice the rate. That's going to more than double your payment for the same amount of mortgage. It'll double your payment. So that's pretty much a non-starter for most families. And it's causing a massive slowdown in the number of homes that are available for sale. Now, this chart is from a study done by a federal agency, the Federal Housing Finance Agency. They do research into the real estate mortgage, and they estimated from the third quarter of 2022 through 2023. So this is for a year and a half period ending in 2023. Doesn't include this year. That there were about 1.3 million less homes put up for sale due to this lockdown effect. In other words, it has suppressed home sales by nearly 60%. Homeowners are staying in place, not necessarily because they want to, but because for them, moving has become prohibitively expensive. So even if they want, more space, kids going to school, better school district, even if they want be closer to work, they're not doing it because the cost, due to the doubling of mortgage rates and the soaring housing prices that occurred after COVID, it just simply can't afford it. It doesn't make any sense. It's kind of like if you own a Tesla and OPEC and Russia and Venezuela have all cut off oil sales, so you're having an oil crisis. It's like you own a 98 Oldsmobile with a 455 cubic inch gas guzzling engine during an oil crisis. You're not going to trade in your Tesla for that. It doesn't make any sense. So this lack of mobility that we're seeing in the housing markets is killing housing inventory. Fewer homes are hitting the market, keeping prices inflated, despite, in some areas, even falling prices starting to fall. Most sellers or would-be sellers are still reluctant, and buyers are finding slim pickings. So it's a kind of a catch-22 that you'll only see in financial markets driven by external shocks, like the Federal Reserve's aggressive rate hikes over the past year and a half. Remember, they were behind the curve on inflation. Remember, inflation is transitory. You heard that until inflation got up to 7, 8, 9%. And then the Fed started hiking, and it did so fairly rapidly, trying to squelch inflation. Well, that created the locked-in effect. So with fewer homes being sold, fewer being listed as for sale, and this drop in supply combined with relatively steady demand, well, voila, prices remain sticky. Prices really haven't come down in most markets. They've even increased in some. Even with buyers struggling with affordability, the lack of available homes is just keeping a very firm floor under housing prices in most markets. Think of it as kind of like being involved in a game of musical chairs, but instead of starting out the game with everybody having their own chair and pulling one, everybody is starting out the game and 3/4 of the chairs have vanished from the start.
How about the all of the new houses being built and apartments and
Well,
condos and
most of those completed. As the rates jumped up, new construction permits kind of tanked.
okay.
So once the ones that were already in progress, well, those were completed, and that helped generate some sales, but there haven't been a whole lot of new startups since.
Gotcha.
So that's further squelching supply. So let's take a look at another key element influencing the market: the Fed. The Fed's monetary policy, the Federal Reserve's monetary policy. We refer to the Federal Reserve affectionately as the Fed, with all the due love, respect, honor, and glory attendant as such.
Okay.
The,
You say so.
I mean, a lot of people want to abolish the Fed. I
Mhm.
think we need the Fed because somebody somewhere has to be in charge of monetary policy. And I don't think you want the president and the secretary of treasury doing it. Now, does that mean that the Fed doesn't need major revisions, structural changes, whatever? No, absolutely not. So I'm not a fan of the Fed. I'm not necessarily arguing to banish it either. But that's a story for a different day. One of my main problems with the Fed is that for the past 20 years, 25 years, they have tried to tinker with the economy, to fine-tune the economy. They have moved from what has been known as rules-based decision-making to a more whimsical decision-making process. Now, the rules-based decision-making is where they have a formula that determines interest rates. Everybody knows the formula. Everybody knows the inputs. Everybody gets the same information and has the same expectations. It was what the Fed operated under in the 80s and 90s when we had that terrific economic expansion, the longest economic expansion we've ever had. It seemingly worked pretty well. Well, that wasn't good enough for the Fed. They decided that they knew better. And so they moved away from rules-based, and you've got a whole team of academics up there. Not one of them has worked in the real world.
You're
Making
freezing
Emma?
a little bit there for a sec.
Sorry.
Yeah. I can still hear you. You were just
Yep. Nothing really I can do to control that, I don't think.
okay.
So they're up there with all their varying theories, trying to find the hot theory to follow in terms of the decision they make. That's why I refer to it as a whimsical decision making.
But isn't that kind of what the Fed does? They tinker with the interest rates to try to level the economy, so to speak, or at least screw with it.
I mean, during different phases of the Fed's history, you could argue that. But if you're on like a rules-based decision-making system, you just generally go with the rule unless there's a crisis that you need to deviate from. Like 9/11. You had the dot-com bubble burst, then you had 9/11, both of them in 2001. Well, at that point in time, right after the 9/11, businesses shut down, canceled contracts left and right because there was so much uncertainty what was going to happen in the economy. So the Fed just literally cut interest rates and pumped liquidity in the system. So it made corporations, if they wanted to borrow money, they could do it at very, very low rates. So it lowered their risk.
Mm-hmm.
So it helped reduce the risk of them making some commitments and kind of help get the economy going again. So I do think the Fed has an important role, particularly in unforeseen crises. But they pushed in my opinion, they pushed their decision-making ability and trying to fine-tune the market into just a colossal screw-up, which kind of has created the mess we're in today. So not a fan.
But is it really the Fed or is it more policies?
Well, the Fed determines the policies, and the Fed has to kind of work in conjunction with the Treasury, because particularly when the Treasury is spending and borrowing so much money, that's kind of I'm getting a little ahead of the game, but that's kind of an underlying reason why some people think the Fed cut, because interest expense for the US government is getting so obscenely high that for rates to remain that high, for rates to go higher to actually control inflation, it would put, you're kind of looking at a non-technical default of government, which you could argue the government is already bankrupt.
Yeah.
It owes more than the income it can afford to pay. Question?
Did you see the Elon Musk interview, where, because he said that he will come in and he will help cut all the fat,
Efficiency, yeah.
and she was like, "What do you think about building all of these EV stations?" He's like, "No, cut it." She's like, "But Tesla," he said, "Cut it." Well, what about this? Cut it. No, just stop the spending. You
Just
have
stop the
to
spending.
stop. She's like, "What about R&D?" He said, "No, nope, cut it." He said the whole bill that they just proposed, he said it's got to go. All of it.
Yeah, the practical reality, it really boils down to two basic theories. One, government can't overspend, it can't overborrow. So you let government spend all it wants, you let it borrow all it wants, and you think it won't have any bad consequences. The other side is, yes, government can overspend, government can overborrow, and that can create severe economic consequences. So that's the debate. You're in one of those two camps. There's really no in between. And, I know which camp I'm in.
Well, I know which one you are too, but there are people who think that, money just grows on trees with the government and it doesn't matter how much they spend, or they'll just get more. Yeah, but they get more, but there is a worth, there is a value to those dollars.
A decreasing value to those dollars.
Yes.
There's actually an economic theory that has gained popularity in the halls of the Capitol and increasingly in the Federal Reserve and the White House, called modern monetary theory.
Is that the Austrian?
No.
Okay.
Absolutely not.
Okay, I can't remember all the names.
Yeah, this is the theory that holds that government can borrow and spend whatever it wants and it won't be inflationary. Cliff Notes version.
Okay.
Yeah. Cliff Notes version. Who was the philosopher George Berkeley? I believe, if I'm correct, British pronounce his name Berkeley, but I believe it's who Berkeley University is named after.
Okay.
Maybe a different Berkeley. Don't hold me to that. But anyway, he once said that, talking about philosophers, that we kick up a cloud of dust and then complain we cannot see. And I think that has become more and more apropos for the field of economics, that oftentimes so many academicians particularly get so entranced in their abstract theories and finding ways to excuse its failures that they've been educated into a sense of imbecility.
My boyfriend's here.
Erwin? I knew who that was. How you doing, Erwin? Good to see you, man. Well, if Erwin's your boyfriend, does that make Sky my girlfriend?
Yeah, sure.
Or one of them?
I'm sure you have more than one.
Yeah, I'll go ahead and throw out Melissa and Jane and
Wow, like Irwin's my only one I got, man.
you've got several people that come to your aid. Carson, haven't seen Carson in a few weeks. Hope he's doing okay.
Oh,
Um,
Sky says she'll take it.
I love a little bit more enthusiasm next time, Sky.
She's like, you'll do.
Yeah.
I'm glad all is well except in the world. I hear you there, Erwin. It's a thing.
Yes, it is. So back to the Fed.
Red flags.
Good luck, Ellen. Red flags.
Hey, look, Clay has all of his girls. I gotta have somebody on here.
Yeah, and for those of you that don't know, Sky/Dogs Discussion and Irwin are very closely related and have been for probably how many years? Decades. One of the
They're married.
cutest couples you'll ever meet.
Yes.
We just love it. We love them both. Yeah. So the Federal Reserve been on a tightening spree for a year and a half, in an effort to try to combat inflation. Well, recently, as in this past week, the Federal Reserve cut rates by 50 basis points. 50 basis points, or 0.5%. 100 basis points equals 1%. So a basis point is 1% of 1%. So what does this mean for the housing market? Well, first of all, let me begin, I guess, by saying let's bust a myth. In fact, I almost called this episode Mythbusters.
Bust a move is what I was thinking.
Bust a move.
Mm-hmm.
Just because the Fed has cut rates doesn't mean that mortgage rates will fall or plummet. What the Fed is cutting is called the Fed funds target rate, the Fed funds rate. And that's the rate that banks pay to borrow money overnight or on very short-term deals. A bank has deposits every day. It has withdrawals every day. And occasionally it has too much money or too little cash, net of the borrowings and the deposits. The net of the withdrawals and the deposits. So if it's short, it has to go out overnight and borrow money and hope next day's deposits make up for it. If you've been running a multi-billion-dollar bank for years, you should have fairly good control on your cash management. So Fed funds is the market in which banks will lend to each other on an overnight or short-term basis. It's an important market. It's the market that the banks use to set a lot of their rates. It's the rate that is used in some derivative markets to help set pricing rates. But for mortgages, not so much. Mortgages are really based more off the 10-year treasury, or associated with the 10-year treasury. The reason is the average mortgage life is about 8 to 12 years, depending on what happens with interest rates. So that's when a bank's issue a mortgage, statistically, they're thinking this is going to be about a 10-year loan on average. So the mortgage market generally tracks the 10-year treasury, the relationship between home mortgage rates and the 10-year treasury is pretty high correlation, not the short-term rate fluctuation. So if we look this week at what happened to rates, well, let me go back real quick. I'm sitting here thinking.
Don't think
I know it's hard not to do. if we look at the history of rates, Fed rate cuts plus home mortgages, you can think about what happened during the 2008 subprime crisis. Obviously, the Fed slashed rates down near to zero. Mortgage rates did drop because the Fed also went out and bought a ton of mortgages. Supply and demand, remember the teeter-totter? So if you have high demand for bonds, for mortgages, prices rise. As prices rise, the interest rate falls. So the Fed took its balance sheet in the years following the subprime crisis from, I don't know, 400 billion to 9, 10, 11 trillion dollars. And that was simply because the Fed was printing money, going out in the markets and buying bonds, buying mortgages to keep the interest rates low, artificially forcing the interest rates low, because the market equilibrium would have never had interest rates that low. So subprime crisis, the Fed pushes rates down, mortgage rates dropped, but housing demand did not pick up. Why? It's 2010. I can give you $1 million mortgage for 4%, which is an all-time low. Why aren't you out buying a house? Well, probably because you're concerned about losing your job. A lot of companies were still laying off, shutting down. There were 9 or 10 or 12 banks closing every month. There was just huge economic uncertainty in the economy. And this, paired with the massive job losses, undermined consumer confidence. Nobody wanted to take on new debt. So people, by and large, weren't interested in buying new homes, regardless of how cheap the interest rates were. So you kind of fast forward to today, and we're at a similar crossroads. The Fed has hinted at another 50 basis point rate cut.
Mm-hmm.
So that begs the question, when in history has the Fed cut rates 50-50, 50 basis points and then another 50 basis points? Usually, well, when has the Fed done a 50-50 cut? I can think of 2 prior examples the past 24 years. Does anybody want to guess what those 2 are?
No, I don't, because I'll probably get it wrong.
How about 2001 with the dot-com bubble and the 9/11?
Right.
And then 2007 with the beginning of the subprime crisis.
You okay there?
Do y'all smell that? Do y'all smell that?
No.
Smells like fear to me.
True.
The only time when the Fed cuts 50 basis points is when they think the economy is tanking. Okay?
I thought you were having some sort of major issue. I was about to call 911. Sorry.
She knows me. But don't worry, though. I could be here collapsing, and Ellen would keep the show going. First thing first. Now, in terms of how really did the market, including the mortgage market, accept the 50 basis point cut with an intimation of additional 50 basis point cuts? Well, this is a graph of the United States Treasury yield curve. I've showed this to you on shows previously, but this basically, the green one is the current one as of the close of Friday, and the gold lighter one is a week ago. And you can tell that current rates have dropped some, the short end. This is the 1 month, 4 month, 1 year rates. They've all dropped. If you see these gold bars below, that shows the amount of the drop. So the 3-month dropped almost, 35 basis points. Not bad, considering a 50 basis point cut in Fed funds. But if you look closely, once you go out to the 5-year, 7-year, 10-year, 20-year, and 30-year, those rates actually increased. 5, 7, 10, 20, 30 increased after the Fed cut. Why would these rates increase? Well, it's because longer term investors in fixed income, both bonds and mortgages, this is their way of indicating a fear of longer term inflation. Investors are demanding a higher rate because of this expectation. So looking at that, how much can you really expect home mortgage rates to drop when the people who fund home mortgages are starting to demand a higher rate?
Very little.
It's not what most people are anticipating. I said I wanted to bust a myth.
Mm-hmm.
Well, I look at that and I consider it busted. Call me Mythbuster, whatever you want. That's the reality as of today. There are some other forces behind that, behind what I call the Fed's fear. Now, the funny thing is that you've got Jay Powell, the chairman of the Federal Reserve, in his speech announcing the cut, talking about the economy is going along fairly well. The jobs data is okay.
Is it?
And I'm like, the jobs data this last week showed 1.3 million full-time jobs have been lost the past year. 1.2 million part-time jobs have been created.
Because we're creating jobs for immigrants. And not for Americans.
That as well. But there's a reason why the Fed cut 50 basis points and intimated another 50 basis point cut. And it's not because the economy is doing swimmingly.
Really? You sure? Stop.
Can you smell it?
Beer.
911
in an ambulance.
As long as they, are all circumcised in CPR and, know how to do it.
Mm-hmm.
And if you look at other data, there's recent data out there showing bank deposits are declining again, particularly among regional and community banks. In the second quarter of 2024, U.S. banks experienced a renewed pressure on the deposit balances. Several large banks saw a quarter-over-quarter drop. M&T Bank, a large regional, reported a 4.4% decrease in deposits. Broader trends show that U.S. banks overall saw deposits fall nearly 5%. Marking the first contraction of deposits on an annual basis since 1994. The problem is banks can't pay higher interest rates like the money market funds can. So, you might have a bank savings account paying 0.5%. You can move it into a money market account paying 5%. A lot of people were doing that. Melissa needs... Waiting on Ellen to answer that.
I told her, I said, yes, he did. She's laughing. That's one of his. I've heard that so many times, it just kind of goes over my head. I'm just like, okay, whatever. Yes, you picked up on it.
So the banks a lot of them haven't been able to raise their interest rates because they're not earning that much on all of their assets. They've got a lot of assets and investment paying 3%. So they can't pay 4 or 5% for deposits. So the only alternative is for them to lose deposits if customers want a higher yield. So this graph is extremely telling of how the market views the interest rate cuts. And that's a big reason why I say, do you smell the fear in the Federal Reserve cutting 50 basis points? Now, here's kind of an interesting chart. I've already mentioned, when is the Fed cut 50-50? Well, 2001, 2007. But this chart is, to me, very interesting, highly informative. The blue line, this chart is basically a graph of the unemployment rate since 1970. And the gray shaded areas that you see are recessions, the official period of the recession. The red circles are the times when the Federal Reserve cut interest rates after joblessness payrolls started decreasing, after unemployment started going up.
Okay, there we go. I was like, joblessness payrolls started.
Yeah, sorry.
It's a long way of saying that. Yeah.
So if you look here, here's where they started cutting. What happened to unemployment? Goes up. Here's where they cut again. What happened to unemployment? Blew up. Well, let's try this one. Here they cut again. What happened to unemployment?
Meh.
What happened to unemployment?
Meh.
How about this one? Unemployment.
More.
Give me a big meh.
Meh. Sound like a goat.
You said it, not me.
No.
The things I could never say and get away with. Now this one is COVID. This is the lockdowns. I can't blame that on the Fed. Government mandated pretty much the lockdown. So everybody locked down. Boom. And so the big question is past prologue. Has the Fed starting cutting rates after unemployment has started increasing, which it has? So can we expect unemployment to soar higher? You be the judge. Now, while we are on cool graphs, this is one that I thought a lot of you would enjoy.
That one's
I love graphs. I love pictures. This is still the monthly unemployment rate from, I want to say 65. The red dots you see are the economic forecast of the leading association of economists. So as you can tell, the economic forecasts were consistently, like in 100% consistently, grotesquely understating, underestimating, underprojecting unemployment.
big time.
Try saying that 10 times fast.
Meh.
So when you see some of these economic forecasts putting out, say, soft landing, all is well, you may want to take that with a grain of salt. Now, honestly, that's a pretty sexy graph, isn't it? That's what I call chock full of information. Picture paints 1,000 words.
I am turned on. Yep. That is sexy.
Picture paints 1,000 words. Now, if you have been paying attention to the financial economic news, you've likely seen that several sectors, particularly, tech, retail, manufacturing, automobile, finance, are all experiencing layoffs, which just this past week hit a 15-year high, while hiring has sunk to near historic lows. The report, and this is from a...
And you want me to get a real job. Come on now.
And miss all the fun.
Yeah, right.
This is the Challenger report, data from the Challenger report. That it's actually technically the Challenger, Gray, and Christmas report, which showed this is a highly respected, highly valued private survey.
That was Chunk.
Which showed August layoffs skyrocketed 193% from July.
Wow.
There were nearly 76,000 jobs lost. The tech sector, and remember, the tech sector is supposed to be our future. The tech sector alone, this engine of the future, lost 42,000 jobs out of the 76,000.
Wow.
Now, as we all know, job security is one of the fundamental drivers of home buying. If you're not secure in your job, not secure in your industry, you're not going to be taking on a huge amount of new debt. When people aren't sure of their income, they hesitate to make large financial commitments, like buying a home. And that's really the trillion-dollar question. Historically, rate cuts help, but there have been times when they didn't, like in 2007, 8, 9, 10, 11, 12, 13. With a softening job market, we probably are going to see even more caution among job buyers, particularly in the regions hardest hit. So I'm thinking that for those hoping that home buying will pick up with the Fed rate cuts, I'm thinking they're in for pretty much of a disappointing year. It simply is not going to have the effect many are hoping for, both either in terms of supply changes or demand changes. And, let's examine, this in a little bit more detail.
Sweet.
The worsening job market, is it kind of like an iceberg, a real estate iceberg ahead? Imagine the economy is the Titanic zooming on through the water, setting a new record. It's kind of hard to steer, which the captain and everybody ignores, and it's headed toward an iceberg in real estate. That is probably not a bad analogy for now. The job market plays a huge role in the real estate equation, and the data we're seeing is not good.
You know what that means, though, Clay?
What?
Gen Z is going to complain more and more and more.
They can't.
They will.
It would be impossible.
It is.
All you Gen Zers out there, I love you. Obviously, all my students are Gen Zers, so I have to give them a little bit of help.
Oh, I guess I can't say too much then, huh?
Yeah. Now, a lot of people will point to the unemployment rate of 3.8% and say it's pretty low. But you need to understand how unemployment is calculated. If you are out of work, been laid off, haven't been able to find a job in 6 weeks, you've sent out 1,000 resumes, you don't have anybody else to send them to, and you kind of, go, it's useless, it's pointless. You fall in a category known as long-term discouraged workers, and you are thrown out of the workforce. You no longer count. So the analogy I make is if everybody in the country were fired and nobody could find a job.
Wait, it would be zero.
After a few weeks, they would all be thrown out of the workforce and the unemployment rate would be zero. Do the math. How cool is that?
The math does math.
Yeah, if we were using the same unemployment calculation we did in the 80s and 90s, the unemployment rate would be between 7 and 9%. Vastly different number than what people talk about today.
Yep.
So when they say unemployment's at a historic low, you're comparing apples and oranges. It's not the same maths.
Are they including the immigrants?
That's a big question. Some yes, some no.
Okay.
Depends on if they, are
They're employed or not.
registered and yeah.
Got
A
it.
lot of them are employed, but the employers don't report the employment. They pay them under the table, pay them cash.
Right.
So that's just a big question. It's a very nuanced question. What we do know is all the key sectors are showing cracks, big cracks. Tech layoffs continue to mount. I mean, Google, Meta, Tesla, all laying off people. Financial services industry, laying off people. Real estate, obviously, you have a lot of people abandoning being agents. They don't have to, declare that they quit because most of them are quote unquote independent contractors.
Well,
Automobile.
that's with hairstylists. That's with insurance agents. That's with real estate agents. That's with a whole number of different jobs.
So, what's the real numbers? I can't tell you, but I'm pretty much willing to bet a certain left part of my anatomy that it's higher than 3.8%. Now, for real estate, this creates a delicate balance. Okay. On a macro level, looking at the whole economy overall, we call it a macroeconomic level. That's different than microeconomics, which is household economics. What impacts an individual family? We're talking about what impacts the whole economy, macro. Employment looks quote unquote fine, to quote our esteemed Federal Reserve chairman. But when we dig deeper, we can see the pain is very, very unevenly distributed. High income jobs. Ma'am?
Excuse me, you're not doing your job. I hear the black one is whining and crying.
Well, let me just pause the show and I'll go attend to his needs.
Just call him down. He is like, you said we'd split him up.
No, I didn't. I said you should take them both.
No, you...
All right, hold on.
Poor Chunk.
All right, we'll see if that works. Poor little dog's insecure.
He is insecure.
There he is. Hello, Chunkers. Say, I need some screen time. So, y'all, this is the uncredited director, writer, producer of the show. This is Chunk in all of his glory with his stinky ass tongue.
Yes.
So, all right, Chunk, you had your 15 seconds. Go away.
What is wrong with you? All right, go ahead.
We like the Chunk. He's a cool dude. He just is a little bit high maintenance. So macro level.
Wait, before we go forward. I didn't say the black one to be racist. We actually do have a white one.
Oh.
And the black one
If
is
you-
like the blue. There you go.
If you look at tech heavy sectors, San Francisco and Seattle, they're getting wasted. Jobs are being lost at an alarming rate. Both cities are going to hell in a handbasket anyway, but this obviously has a direct demand on housing in these areas. I was talking with a real estate person in Seattle last week, and she mentioned that 6 months ago, most real estate agents had multiple offers on every home listed. Today, absolute crickets. Nothing. What's more troubling is that many homes have been sitting on the market for weeks, months, without any serious offers. This obviously wasn't the case a year ago, hadn't been the case really since 2020. Um, but it speaks to the great amount of uncertainty creeping into parts of the market. Florida, everybody and their brother since 2020 COVID hit has been flocking to Florida. Housing prices soared. Well, just this past, few months, people have found out that you can't get homeowners insurance. A ton of home insurers are pulling out of the Florida market. And so the homeowners now can't get insurance, or if it's offered, they can't afford it because the premiums have just absolutely skyrocketed. Well,
It wasn't easy here.
no. So folks are being forced to sell in Florida because they can't get insurance. So, what will that do over the next few months to prices in Florida? As job losses stack up in some of the other states, as Florida real estate crashes or falls, I have no idea how much. It could kind of lead declines in the national average because that covers a lot of personal real estate. Some forecasts show that in tech-heavy areas, prices could fall by 15 or 20% over the next year. So the softening job market puts significant downward pressure on home prices, particularly in areas that rely on industry facing the most disruption, like tech-heavy cities, like Florida. So let's talk geography, because ultimately all real estate is local. What is happening in San Francisco isn't necessarily happening in, other cities. I want to say Miami, because the real estate in Miami has been pretty hot. Now, seeing what we're seeing from insurance and people being forced to sell, that's probably going to turn around pretty quick. But let's start with the bad news. You've got cities like Austin, Texas, San Francisco, Seattle, all of them heavily vested in the tech industry, all seeing major price corrections currently. These were the darlings of the pandemic-fueled housing boom because of the growth in tech, people fleeing, to tech. But with tech layoffs, stacking up, a lot of those workers rethinking remote work, demand has cooled significantly in those cities. Combine that with the very high home prices, prices that soared over the past 3 years, you've got the perfect recipe for significant declines. Again, some of these markets will probably drop 20%, maybe more. On the flip side, you've got cities like, I could list, actually, if I was just looking at the data over the past year, I could list most every city in Florida: Fort Lauderdale, Pensacola, Miami, Jacksonville, Orlando, Tampa. All of them have had huge increases.
Mm-hmm.
Past is not prologue. I don't expect that to hold. So I'm kind of excluding Florida now, because Florida is, those prices are not going to hold. But what about the other cities that have shown pretty significant increases, like Dallas, Arlington, Raleigh, Nashville? You've got businesses and individuals over the past few years that have relocated to these cities, areas, suburban metropolitan areas, I guess I should say, just in droves due to favorable tax policies, business-friendly environment, fleeing the high taxes, high regulation of some of the northern areas. Another city that's a little bit closer to us that is worth watching is Charlotte. Once a very quiet, little stodgy banking town, Charlotte is just blown up. Not anymore. It is just a hub for finance, tech, healthcare. It's pretty close to the Research Triangle.
RTP.
Benefits from some, overflow from that, proximity to that. And job growth in these broad industries is keeping demand for housing strong. and prices have risen. While they have risen, they're still not close to the California levels, the insane levels that you see in California. If we talk, we've talked about some of the cities, we should probably mention states. The same applies. You only have to kind of scale it up in terms of the broader impacts. Declining states, California, New York, Illinois. I have Florida there with a question mark. It really doesn't show up in the data yet, but it won't be long. We'll see it there soon.
Clay, can you make a note? I don't have any paper on me.
Send me a map after that show.
The map. Mm-hmm.
I certainly can.
Will do.
Certainly will.
Consider it done.
Thank you. So California, New York, Illinois have, kind of led the way in declining. Flip side, you've had the states that have shown, fairly solid growth, relatively stable growth: Virginia, Wisconsin, Tennessee. Now, one of the articles I showed you earlier, the Atom article, was published by a real estate data firm, Atom, and they were describing a report that showed California, New Jersey. It's really where this data is taken from, and you can see the article posted there. This is one of the ones that was sent to me along with the question, and it shows California, New Jersey, and Illinois had the biggest concentrations of at-risk markets in the country. Obviously, you have huge clusters in New York City, Chicago, almost all of inland California, the Bay Area, LA, etc. The less vulnerable markets to the, job losses would generally be positioned in the South and most of the Midwest. So, nearly half of the markets considered least likely to decline. Nearly half of them fell in Virginia, Wisconsin, Tennessee, Carolinas. So if you're in the market to buy or sell, this is obviously something you want to keep a close eye on, the local dynamics of the markets that you're investing in or considering investing in. Not every market is going to behave the same way. Not every market is so dependent on tech or manufacturing or finance. The research triangle has done well because a lot of it is dependent on pharmaceutical companies, and pharmaceuticals have had a good couple of years.
Yeah, GlaxoSmithKline is huge.
Yeah, Pfizer's up there, several. That could change with a new administration. So, if you think that's a good area, it's pretty stable, pharmaceutical people are always going to need drugs, kind of depends on November. Because some of the government has funneled tons of bucks to big pharma over the past 3-4 years. I doubt, particularly if Elon is in charge of efficiency, that will continue.
Yeah, through the jabby jab. That has been huge.
So anything that has profited greatly by government spending, I would just be cautious of. Another factor to consider, and a real wild card that we haven't unpacked or talked about yet, is inflation. Inflation is a huge key to real estate's future. The Fed is, I have friends working in pharma and they are starting to see cutbacks. Yeah, the heyday may well have passed. And that drop off from the heyday may turn more into a landslide from the heyday, depending on who wins.
I mean, do you think they're going to come up with another pandemic or crazy virus that will just boost that again?
I mean, there,
People are see through it.
sometimes you just follow the money and it makes you kind of want to say yes. Flip side is, will people react the same way? They've seen the
Right.
harm and the damage that the lockdowns did, that closing of the schools did. They've seen the harm that, some of the vaxes did.
Do you know how many people I see driving down the highway that are still in their cars by themselves?
Oh,
With them?
I'm not saying there's some that won't,
Yeah.
but I'm thinking by and large there's a lot of people that are like, oh hell no, again, for part due of all that. Um, we'll see, but that's just my hunch based on what I see and hear in discussions, with people from around the country and different commentary.
Okay.
So, like I say, the big thing we haven't really unpacked is inflation, which is a huge key to real estate's future. The Fed is trying very hard to thread a needle, a very, very delicate needle, a very, very small, fine needle. If they cut rates too aggressively, obviously it could reignite inflation. I showed you the Treasury yield curve where rates on the longer end had increased. So obviously there's already some expectation that inflation is going to increase. I mean, core CPI, core PPI, both have been increasing for the past 4 months. Core CPI hit the highest monthly rate in 6, 7, 8 months. There's signs that inflation is already increasing, which makes Powell doing such a large cut even more unusual.
Okay.
It makes me think the smell is strong.
I was like, huh?
Yeah, you look at the and you have to understand the Federal Reserve follows core CPI and core PPI. It considers them more important measurements than the regular CPI. The regular inflation index, core CPI, just takes out energy and housing because energy and housing fluctuate a lot. So it's trying to look at the core inflation rate in the economy as a whole, taking out two of the most volatile elements. And it's been increasing 4 months. That's 4. 4 months straight. That's 3. That's 4. So there's to see Powell cut 50 basis points and almost kind of indicate he's going to do another 50 next month. I can only interpret that as a sense of panic, of fear, despite his words, despite his trying to reassure the markets that this is not the Fed panicking. This is just okay. So it's a very delicate balance the Fed walks. So if they cut too fast, cut too much, they could stir up inflation again, which would send mortgage rates soaring again, put even more pressure on the housing market. Now, the reaction to the Fed cuts, exactly how that will be interpreted in the economy, is also related to what interest rates are around the world. We do, as far as money flows, capital flows, we live in a global climate. So what are other central banks doing? Well, if you look at this chart, you can tell this is US, Canada, Sweden, Euro, Switzerland, New Zealand, UK, Norway, Australia. All of them have obviously hiked rates fairly much in lockstep, have plateaued, and most have begun cuts. A couple, Norway and Australia, are still pausing. They may cut this next month. One really, really stands out different than the rest. That would be Japan. And you'll notice for such a long time, they've had negative interest rates. We talked about that previously, but negative interest rates. Negative interest rate is where you lend somebody your money and you pay them interest. That's a negative interest rate. And so that's Japan's borrowing rate. Well, recently they just have hiked twice and got their rates up positive, still low, but positive. They're also encouraging Japanese investors to bring their money back into Japan, sell US bonds, sell Swiss bonds, whatever else they own, and invest it back in Japan. And kind of seeing that happen. So what happened to the dollar? Because the dollar strength, dollar weakness. Dollar weakness promotes inflation because it takes more dollars to buy the same foreign good. That's inflation. So what happened after the Fed cut? Well, Friday, the dollar fell against the yuan, the euro, the Swiss franc. There was one that was different, and you can spot it by looking at the graph. The dollar rose against the yen. And this was due to kind of a short-term phenomenon, believing that the BOJ, the Bank of Japan, would not hike again this month. Now, I've stated a couple times that I think the BOJ will hike in January because inflation, we just saw the data, inflation has risen in Japan for the fourth, I can't get my numbers right, the fourth straight month.
You got it
so
right.
I thought well, at first I did some, other kind of worthless hand motion. I don't know what I did. It's hard to think and talk and handle the broadcast at the same time. That's my excuse, and I'm sticking to it.
Handle the broadcast. I thought that's what I was doing.
Well, the slides and
okay, but you go ahead.
Everything.
You get credit for it.
Because I'm reading the slides, trying to interpret them, offer some explanation, and so sometimes I get lost in thought.
Jane says, I agree with Clay. It reeks a stench. It's stinchy, stinky.
Yeah, when I was in investing, I would do due diligence on certain proposed projects or investments. And, sometimes I couldn't point to any specific quantitative or financial aspect I didn't like. There was just something that didn't seem right about it. So I would say it didn't pass the smell test. So, yeah, this action from Powell just doesn't pass the smell test, my opinion. So BOJ, I'm thinking they'll hike instead of January, maybe December. The problem with BOJ hiking is that Japan is kind of in a bind. They have borrowed so much money over the past 20 years, it's 240% of GDP. For comparison, ours is about 130, a little less, which is obscene, but Japan's is doubly obscene. So if they hike even a little, that will cause a huge drain of government money. Cost the Japanese government tons of money, more than what they can afford. So if you look at reality, the BOJ can't hike much. They'll destroy the government. So what do they do, in terms of combating inflation? Well, maybe they can do one more hike. So we saw what happened in August when the BOJ hiked 1/4 point. What happens to the dollar again when the BOJ hikes another 1/4 point, which I kind of strongly think that they will. Combine that with the Fed continuing to cut rates here.
It's going to be a shit show.
Yeah, it's, if I did currency futures, I would be shorting the hell out of the dollar. I don't do currency futures because it's a very technical market. Things can change very quickly. I obviously don't have my finger in it, my eyes on it all the time, which if you're going to do it, you probably need to. And you need to be able to weather fluctuations because, slight fluctuations will cost you big. You might be right in the long term and not be able to afford it in the short term.
Like GM.
Yeah, we won't talk about that.
Okay.
Now, looking at the Fed, the theory is if the Fed doesn't cut rates enough or fast enough, we could see further slowdown in economic growth. I don't think I don't think there's anything the Fed can do quick enough to really moderate the slowing in economic growth we're seeing. I think we could see some real pain in the housing market. I mean, if you look at some of the precursors, some of the signs like delinquencies, defaults on automobiles, they've been rising. And this is, a couple of issues. One, it poses a great threat to banks, small and regional banks who do most of the auto loans. Banks don't handle defaults well. So even if this part of their portfolio is experiencing higher delinquencies, higher defaults, that's a hit to their capital. That's a problem when they're already seeing runs on deposits. Secondly, defaults on auto loans point out consumer weakness, severe consumer weakness, because people prioritize their automobiles. They don't want their autos repoed.
Really?
So they will try to do most whatever they can to pay for their automobiles. When you see those rates starting to get abnormally high, that's a big red flag. That also could have factored in Powell doing a larger cut, added more pressure for the Fed to cut. They don't talk about it, but they're aware of it. Now, most economists who, I will say, believe or argue the public spiel on the economy, soft landing, all is well kind of crap. Most economists surveyed thought the Fed would do a 25 basis point cut. And honestly, I thought the Fed would do a 25 basis point cut because of increasing inflation. I thought Powell would be hesitant to cut because of spurring more inflation. Well, he went ahead and did the 50 basis points because the economy is showing some real signs of pain. But as far as the economists, the vast majority thought 25 basis point. But we saw and smelled what actually happened. Now I expect all of y'all to be going around sniffing the air, telling everybody you smell fear in the Fed. So the Fed is trying to balance all of these issues. And honestly, I don't envy them. There is no clear-cut formula. Every move they make, every move they don't make brings up complications. So the bottom line is the Fed's balancing act is going to have a massive impact on home prices over the next year, year and a half. Exactly what those impacts will be is anyone's guess as to which direction it'll go. Honestly, in 2020 with the soaring home prices, I did not foresee the lock-in effect. If rates increased, we've never had it before, just, didn't bother to think about it for a minute. Hell, I refinanced my mortgage at 2.5%. It was kind of stupid not to. It's free money. So, but yeah, I don't want to sell my house and buy another house. I understand. I'm not knocking those people in that position, but just trying to describe the basic economic situation. Now, we haven't talked about commercial real estate. I've talked about it repeatedly over the past year and the dire straits it's been in. So let's not forget it's still a growing problem. If I can refer to it as a shitstorm, I would, but that's probably not polite. We've seen in CRA.
I don't see any problem with it.
Well, particularly with office and retail space, we've seen those two getting hammered. New retail space is doing okay, but with the continuing collapse of existing older retail space, drops in price, it's bound to start impacting the new space before long. And here are a couple examples. In Minneapolis, a building just sold for, and it's the silver one pictured, $6 million. $6 million. In 2019, it sold for $74 million. So we've seen this in San Francisco, in New York, in Atlanta, in Minneapolis, in Seattle, in Austin. This is a national problem, not a regional or local problem.
This is commercial office space, correct?
Commercial office space.
Mm-hmm.
It's also hit commercial retail space, and now is apparently hitting some residential space. The bottom picture is a complex in Atlanta, in Buckhead, in Buckhead, where the borrower just handed it back to the lender, to the bank. In 2022, they refinanced it at $137 million. Well, they took out an adjustable rate loan, which, if you think about it, you've got interest rates at absolute historic, just low rates, the lowest rates we'll ever see in history. And they took out an adjustable rate loan.
So what happens is, the interest rates goes up, they can't pay their mortgage or whatever it is, because they have to increase the rent to the people who are renting from them, and they can't afford it. They leave. So then they're stuck with this building and all this space and nothing to do with it.
And they have rental contracts. They can't just willy-nilly increase the rates until the contract expires. Well,
usually that's within a year.
Yeah, their financing rate hit 9.1%. So they just handed the deed back over to the lender. Now, one interesting thing about this building, titled the Lofts 25 in Buckhead, it has a population clock installed in it. Ted Turner installed it in...
What?
Yeah. That was kind of its claim to fame. It has a population clock in it.
When?
Installed in 1965 by Ted Turner. Yep.
That's
the building
crazy.
Actually was built in the 50s.
Huh.
The occupancy rate of the building dropped from 58% to 26% in 1 year. Because
Wait, is this the population clock for the building or for the
no,
United
for the
States?
entire world. Entire world.
Oh, okay. Wow. Okay. Huh.
Yeah, so that was kind of its claim to fame. Ted Turner was concerned about the population way before anybody else.
Darn.
And like I say, the occupancy rate of this complex fell from, near 60% down to 25%, 26%, just in 1 year, from 22 to 23. So rather than trying to hang on, continue losing money, the borrower just defaulted on it.
I want the population clock.
Yeah. So the point is that not only is commercial space, retail space, but also residential space is starting to get hit by the higher interest rates, higher cost, job losses, all those combined effects. So bottom line, for those of you in the real estate market are having some interest in investing in the real estate market, whether you're buying, selling, investing, whatever, information, you need to stay informed. You need to have an ability to adapt, somewhat anticipate changing conditions. So in order to help you with that, you want to pay extremely close attention to Fed policy. Keep an eye on trends in the local job markets, and try to maintain some flexibility. And, don't be stupid. Don't take out adjustable rate loans when the rates are at all-time lows. That's just never going to work out good. Never in your favor. Bottom line is, don't take risk you can't afford to lose. Don't take positions you can't afford to lose in. There's so much uncertainty out there. So much uncertainty. And uncertainty is code for increased risk. Increased uncertainty is increased risk.
Yep.
So that's my brief review of housing real estate. I hope that helps, gives you a little bit better perspective. Anybody have any questions on anything that I mentioned, said, didn't say, didn't cover, should have covered, wanted me to cover?
Forward you an email from Jane that has to do with this, but I didn't get a chance to go through it. But if you want to take a look at that.
Let's see.
I'm not sure if it's from the channel email to you. For some reason,
wrong one.
on my phone. No, it's to work. It's just from the channel, which is not going to make any sense to you. But there it is.
Okay, there it is.
Ding.
Well, trying to open it. There it finally goes. This is the page.
Mm-hmm.
And historical mortgage rate chart. Thank you, U.S. News. This kind of ties into what I was just saying. You know, if you look at mortgage rates over time, now this goes back to, I think, 1970, 71. And you can kind of ballpark, an average. The median is 7.37%. You got to keep in mind, if you went back further, the average mortgage rate is going to be between 6 and 8% most every decade.
Except for the 80s, that was awesome.
Do what?
Except for the 80s. That was a great interest rate year.
Yeah, my first house in the 80s, my rate was 12%. Yeah. But if I wanted to buy a house, that was it.
That's
now,
true.
Here it shows the low at 2.65. That's the national average. Like I say, I hit mine at 2.5. But yeah, this is just stupid low. Stupid low. Think about it. Would you want to loan somebody 30-year money for 30 years at 2.5%, knowing that 2.5% was taxable to you? So after taxes, you end up with 1.8%. You've got inflation going at 3, 4, 5%. So what you've basically guaranteed is that your money will purchase less in the future than it does today. You've guaranteed yourself a loss in value after inflation. That's just stupid. And what's my rule number 2?
Stupid should hurt. It's on the hat.
Stupid should hurt.
I don't have mine.
I don't have a hat to show you. Yeah. But we'll actually be getting, some of those and putting them up online.
Once Ellen gets the store set up. Ellen's working on it.
Spread the word. It's a cool hat. Cool ass hat. It's actually a good quality hat.
It's a soft hat. It's awesome.
Yeah. It has the M logo, but on the back it has stupid should hurt. My rule number 2. Sometimes I think it ought to be my rule number 1, but it's rule number 2.
What is rule number 1?
Jane, thank you.
Do as I say, when I say, how I say,
when I say,
and you'll be all right. All right, yeah, whatever.
And you will be all right. That's the 5th aspect. So
that's why we don't date.
And she's the one that always gets mad at me because I'm right.
No, I get mad at you because you don't see my side of it. Just saying.
Well, in matters generally pertaining to finance, we'll just kind of agree with that.
We do need pup tees so stupid should hurt on them. We do.
Yeah, that would actually be pretty cute.
Sky's got a hat. Heck yeah, man.
Yeah, several of y'all do. Several of y'all do have hats. So We ought to get some pictures from everybody and post them.
I have them. I
Do
just
you?
don't want to post them without permission.
Well, ask permission, and then we'll post some of them on the show. And if you don't want to, don't. Absolutely don't. This is the internet, and some people have reasons for not wanting to have everything public. I completely understand. That is never going to be a problem with us. So
That's why we changed my name to E-Train.
yeah,
That became a problem.
We actually had some issues there.
Mm-hmm.
So if you need graphics, let me know. We definitely will. Melissa has a gift with video graphical stuff, and if y'all need somebody, send us an email. We will forward it to her.
We'll connect you. Mm-hmm.
Yeah,
absolutely.
She is gifted at that.
Speaking of, show me the money! There you go.
Starring the illustrious Green Bean, but still the greatest swoosh. And every time I see that, honestly, it makes me laugh. Just makes me a little happy. All right. A few other points. Just a few. This is kind of what I thought may be the cool pick of the week. This is former President Trump in a Manhattan bar buying his first Bitcoin. Now, we have talked about Bitcoin. We've had a couple short shows on Bitcoin. We'll continue talking about it. It is a increasingly interesting risk asset. But there he is. He has actually promised to set aside a Bitcoin reserve if he's elected.
And yes, Jen, I actually did tell Clay about the X Spaces conversation. I doubt he's watched it yet. Probably not. Or listened, Moffat?
Maybe not. Don't know if I have seen it yet.
It's just an audio.
Okay. And, please understand, sometimes it takes me a little while to get to stuff. I get probably 200 emails a day, 250 emails a day. And so it takes me, and some of them are sorted in different categories. Obviously, student emails are up the priority list. So if I don't respond quickly, it's not necessarily that I'm trying to ignore you or whatever. Hopefully I will get to you. If you've asked a question and I don't reply, then please resend it or
irritate
let me know. Irritate Ellen.
And I will irritate him.
It has been sorted off to some junk filter, or in deleting the 250 emails, I accidentally deleted it. I don't know. Could be any number of things, but do want to try. If you've got a question or legitimate issue, do want to pay attention to that. So Trump buying his first Bitcoin kind of begs the question, is decentralized finance the future? And by decentralized finance, like Bitcoin is decentralized finance because no government controls it. It doesn't exist by the leave of any government. You can access it independent of any government's desires. It's more convenient to do it through an exchange like Coinbase, which the SEC has approved. You can now buy Bitcoin futures, ETFs, whatever. Mm-hmm. So all of those things are regulated. But if, like China has tried to outlaw Bitcoin 3 separate times, people in China still buy it. You can still access it via direct means. If you have a flip phone, you can buy and sell Bitcoin. The old school Nokia flip phone. So But I thought that was kind of interesting with Trump buying his first Bitcoin. The second slide shows gold. A lot of people have expressed some interest with gold. So what happened to gold after the Fed cut rates? Basically, gold rose to an all-time high after the Fed cut, which this most likely indicates increasing uncertainty. Remember, uncertainty is risk. So increasing uncertainty in the country and in the world. So if you think the future is increasingly uncertain, if you think increasing chaos is coming, then gold probably has a solid future still. It still could have a fair ways to go. But I thought that was interesting. And this actually is gold over the past month from about 2250 to 2650. So it's up almost $100 or 4% in 1 month alone. That's not horrible. Now, for those of you who are on Social Security or who are close to going on Social Security or who hope at some time in the future to go on Social Security, report just came out showing that the Social Security Reserve Fund will go through all of its reserves in the second quarter of 2033 at the current rate. This, if it spends all of its reserves, then by law, it has to cut benefits to everybody, the disabled, to married, to singles. And you will likely lose about 1/5 of your benefit. So a dual income couple stands to lose about $16,500 a year. Single stands to lose about 12,000, somewhere around there. The study was done by a committee for a responsible federal budget. And they pointed out that based on current reserves, current spending levels, that Social Security will hit that magic number of 0 in reserves about the third quarter, into the third quarter in 2023. This will cut benefits to the current 70 million recipients. Also, don't forget that illegal immigrants, once they apply, granted asylum, they are then qualified to receive full Social Security benefits for 7 years. How cool is that? And that's it. That's all, kind of I had tonight. What questions, comments do y'all have?
Well, I wouldn't have left if I knew you're done. Let them out for a second.
There is a train with the Roo, the pups,
The goofball.
the goofballs.
So are we done? Is that the thing?
That very well could be.
Ouch, ouch, ouch.
Wanted to just ask if anybody had any questions. We've covered basically the locked-in effect. Talked about the Fed's rate cuts. We've talked about whether the markets are poised to rise or fall. Want you to remember that real estate isn't just about timing the market. It's about understanding the forces shaping it. So if you like today's episode, please remember to, as the screen said, smash all the stuff. Subscribe, share, leave us a review.
Hit that like button.
Hit that like button, and we would be most appreciative. And as always, if you have some questions, comments, email me, moffitonmoney@gmail.com, DM me at Twitter. If you've got some ideas you'd like to see in future shows, this was an idea suggested by one of the fam, and we appreciate that.
Bye, Miss Jane.
Yeah, I'm always hesitant to give out somebody's name without their permission. Ellen is the one who handles most of the communications with y'all and pretty much understands, which ones are more bashful than others. So I'll leave that to her. But
Thanks, Erwin. Thanks, Guy. Thank you, Melissa and Jane.
Thank you all.
And all the rest of you, the replay crew.
And the replay crew. We do appreciate you guys very much. Don't y'all forget to hit that like button. We'll get the store up soon for the hats.
I'll do that quickly. Yeah.
And we love you guys. We hope y'all have a great rest of the weekend. Blessings to you all. Our time is up. We thank you for yours.
Right.
Good night.